Markets don't brace for nothing. They don't brace for speeches. They don't brace for noise. They brace for pressure. And right now, global markets are bracing for one thing: Donald Trump. Not because he's unpredictable, but because when he moves, the rules change. I've been doing this a long time, long enough to recognize the difference between panic and preparation. I've watched markets through wars, recessions, booms, bubbles, and collapses. And I want to say something very clearly right at the beginning. What you're seeing right now is not fear of America failing. It's the world adjusting to America asserting itself again. Gold is rising. The dollar is moving. Investors are repositioning. And this isn't happening because Donald Trump is weak. It's happening because Donald Trump is unpredictable in the one way global markets fear most. He's willing to use American power. I'm going to walk you through what's actually happening without the panic, without the propaganda, and without the fake narratives you see everywhere else. But first, let me tell you where I'm coming from. I'm not a politician. I'm not a pundit chasing clicks. I'm a political and economic narrator who has spent decades watching how money reacts to power. And money always tells the truth. Over the past several days, investors around the world have shifted into what we call risk-off positioning. That's when capital moves defensively. Gold rises, silver follows, currencies adjust. Not because the system is collapsing, but because the system expects turbulence. And turbulence is exactly what happens when old assumptions break. For years, global markets operated under a very comfortable assumption. America would absorb the cost. America would keep markets stable. America would prioritize global consensus over national leverage. Donald Trump shattered that assumption. So now markets are doing what they always do when the rules change. They hedge. Gold moving higher is not a vote against the United States. It's insurance against volatility during negotiation. Gold doesn't rise because investors think America is finished. Gold rises when investors think America is about to force change. That distinction matters. The same applies to the dollar. You're hearing a lot of noise about the dollar weakening, as if that automatically means something is wrong. But currency movement isn't moral, it's strategic. A slightly softer dollar makes American exports more competitive. It pressures foreign producers. It rewards domestic manufacturing. That's not accidental, that's leverage. And leverage is something Donald Trump has always understood better than career politicians. Markets don't like leverage being used aggressively, especially when they don't control the outcome. That's why you're seeing repositioning, not flight. Money is not leaving America. Money is waiting to see how America plays its hand. Now let's talk about tariffs, because this is where narratives get dishonest. Tariffs are not punishment. They are tools. They are pressure points in negotiation. And when Trump brings tariffs back into the conversation, markets react because they know something important. Deals are about to be renegotiated. Global supply chains built on cheap labor, favorable imbalances, and American tolerance are being questioned again. And that makes investors nervous, not because it's bad for America, but because it's bad for the old system. For decades, the United States accepted trade arrangements that looked good on paper, but hollowed out the real economy. Manufacturing moved overseas. Dependency increased. Wages stagnated. Markets loved that arrangement. Trump didn't. So when tariffs re-enter the conversation, markets don't assume chaos. They assume confrontation. And confrontation introduces uncertainty. But uncertainty is not weakness. Uncertainty is leverage. Now add another factor into this picture: government funding. Yes, there are debates in Washington. Yes, there is talk of a possible partial shutdown. And yes, markets react to that. But let's be honest. Washington has gone through funding standoffs many times before. Markets always react early. Politicians always resolve it late. And the system moves on. The difference now is context. This funding debate isn't happening in isolation. It's happening alongside trade negotiations, border enforcement priorities, and a broader shift in how America asserts its authority. Markets aren't reacting to the shutdown risk itself. They're reacting to the combination. It's the stacking of pressure points: trade, currency, fiscal authority, negotiation posture. That's what makes this moment feel louder than usual. And when things feel louder, people mistake noise for danger. But experienced observers know better. Danger looks different. Danger looks like credit markets freezing. Danger looks like mass capital flight. Danger looks like systemic bank stress. We're not seeing that. What we're seeing is hedging. Gold and silver rising tells you investors expect volatility, not collapse. The dollar adjusting tells you investors expect negotiation, not surrender. And the resilience in equities tells you something even more important. The foundation is holding. Corporate earnings have not collapsed. Employment hasn't fallen off a cliff. Consumption hasn't frozen. That's not what weakness looks like. That's what transition looks like. And transitions always scare people who benefited from the old system. There's another layer here that doesn't get talked about enough. Foreign governments and institutions became accustomed to an America that was predictable, restrained, and often hesitant to use its full economic weight. Trump disrupted that comfort. He introduced uncertainty not just into markets, but into diplomacy. And diplomacy built on comfort always favors the other side. So now, as tariffs are discussed, as trade terms are questioned, as funding authority is asserted, markets are being forced to price something they haven't had to price in a long time: American resolve. That's uncomfortable for global finance, because resolve limits optionality, and optionality is how markets profit. When Trump removes easy assumptions, markets respond defensively. That's what you're seeing right now. Not panic, not collapse, not loss of confidence, adjustment. I've watched this pattern repeat throughout history. When strong leadership reasserts national interest, markets wobble first and stabilize later. When leadership avoids conflict, markets relax, even if the economy rots underneath. Trump chose confrontation over quiet decline, and markets are reacting accordingly. This moment is not about fear. It's about recalibration. And recalibration always starts with gold, currencies, and hedging. The question isn't whether America is strong. The question is how the world adjusts when America decides to act like it again. Markets don't brace for nothing. They don't brace for speeches. They don't brace for noise. They brace for pressure. And right now, global markets are bracing for one thing: Donald Trump. Not because he's unpredictable, but because when he moves, the rules change. What's important now is to understand how different this moment is from the stories people are trying to force onto it. A lot of commentators want to frame what's happening as instability. They want to say the markets are losing confidence. They want to suggest America is somehow becoming risky. That framing is lazy, and it's wrong. Markets are not emotional. They are mathematical. They respond to incentives, constraints, and power. And power is what's shifting right now. For years, global finance operated under a very specific expectation: that the United States would continue to act as the stabilizer of last resort, that it would tolerate trade imbalances, that it would absorb volatility created elsewhere, that it would prioritize global liquidity over domestic strength. Donald Trump never accepted that role. and markets know it. That's why they're adjusting now, not because something has broken, but because the old playbook no longer applies. When tariffs come back into focus, markets don't assume they're permanent. They assume they're leverage. They assume negotiations are underway behind closed doors. They assume outcomes are still being shaped. And that uncertainty forces defensive positioning. Gold becomes attractive because it's neutral. It doesn't belong to any government. It doesn't depend on any agreement. It simply preserves value while decisions are being made. That's why gold moves first in moments like this. Silver follows for similar reasons, but also because it sits at the intersection of finance and industry. It benefits from hedging, but also from expectations of real economic activity. That combination tells you something critical. Markets are not pricing in recession. They're pricing in restructuring. Now let's talk more about the dollar, because this is where narratives really start to drift from reality. A strong dollar sounds patriotic. It sounds like success. But a dollar that is too strong for too long comes at a cost. It hurts exporters. It encourages offshoring. It rewards imports over domestic production. Trump has always been willing to accept short-term discomfort in exchange for long-term leverage. And a dollar that adjusts during negotiation phases is part of that equation. Markets understand this better than commentators. They know currency moves are not just reactions, they're signals. A softer dollar during trade renegotiation phases gives American producers an edge. It forces foreign exporters to compete harder. It pressures countries that rely heavily on access to U.S. consumers. That's not weakness, that's strategy. And strategy is what global investors are trying to model right now. They are asking questions they didn't have to ask for years. What happens if trade terms shift? What happens if supply chains are forced to move? What happens if access to American markets becomes conditional again? Those questions don't have easy answers, so money hedges while it waits. Now layer on the political dimension. Government funding debates are messy. They always are. But markets are not reacting to the idea of a shutdown itself. They've seen that movie before. What they're reacting to is how funding debates intersect with enforcement priorities, trade posture, and executive authority. This is not a routine budget squabble. This is a negotiation over direction. And direction matters more than deadlines. When markets see that leadership is willing to hold firm, even in the face of political pressure, they factor that into risk models. Resolve increases volatility in the short term, but it reduces uncertainty in the long term. And markets are trying to decide which phase we're in. That's why you're seeing caution without collapse. There's also an international dimension that's easy to miss if you only listen to domestic commentary. Foreign governments are watching these market moves very closely. They understand what gold surges and currency adjustments mean. They've lived through moments like this before. They know this is what happens when the United States stops signaling restraint and starts signaling conditions. And that makes negotiations more serious. For decades, many countries benefited from an America that was predictable to the point of passivity. Trump ended that dynamic. He introduced a variable that can't be easily modeled: political will. Markets hate political will because it can override incentives. That's why you see hedging behavior. That's why you see capital moving defensively. Not because investors think Trump will fail, but because they don't know exactly how far he'll go. And uncertainty about resolve is more destabilizing than uncertainty about weakness. Weakness can be exploited. Resolve must be negotiated with. That's the difference. Now let's talk about something else that's important. Despite all the noise, despite all the headlines, despite all the charts people are flashing on screens, the American economy itself has not cracked. Employment remains resilient. Corporate profits remain intact. Consumer activity remains steady. That's not accidental. It's because the real economy, the one Trump talks about, is not the same as the financial narratives pushed by commentators. Factories, energy, logistics, domestic production. Those sectors respond to policy direction, not sentiment. And the direction right now is clear. America First is not a slogan. It's a negotiating stance. And markets are being forced to adapt to that reality again. There's something else happening beneath the surface that most people miss. When markets hedge, they don't just protect downside, they prepare for upside. They reposition so they can move quickly once clarity emerges. That's why you don't see mass selling. That's why liquidity remains deep. That's why capital stays largely within U.S. systems. Money isn't leaving America. It's waiting for the next signal. And the next signal will come from outcomes, not headlines. Trade frameworks, funding resolutions, policy enforcement. Once those pieces start locking into place, hedges unwind, gold cools, currencies stabilize, volatility fades. This cycle has played out many times before, but it only plays out this way when leadership forces a reset. Trump forces resets, and resets are uncomfortable for people who prefer inertia. That's why narratives get emotional. They need panic to compensate for loss of control. But markets don't panic without cause. They hedge. And hedging is what you're seeing right now. This is not the end of something. It's the middle of something. And the middle always feels uncertain. But uncertainty does not mean weakness. It means decisions are being made, and the world is paying attention. I want to slow this down now, because this is where understanding really matters. If you're watching markets every day, it's easy to get pulled into short-term movement. Charts tick up, charts tick down, headlines flash red or green, and people start assigning emotion to numbers. But markets don't feel, they calculate. And right now, the calculation being made is not about collapse, it's about control. For a long time, global finance operated on the assumption that the United States would always choose stability over leverage, that it would avoid confrontation, that it would smooth outcomes, even when smoothing meant absorbing losses. Donald Trump never accepted that premise. He treated American economic power the way negotiators treat leverage, something to be used, not something to be hidden. That single difference changes everything. When leadership signals that it is willing to tolerate short-term volatility in order to force long-term advantage, markets have to rethink risk models that were built for comfort, not confrontation. That's the shift we're watching, and it's why gold has been moving the way it has. Gold doesn't move like this when people think nothing is happening. It moves when people think something big is being decided. And something big is being decided. Trade terms, enforcement priorities, negotiation boundaries. Those aren't abstract concepts. They determine who benefits from the global system and who bears the cost. Trump's approach is very simple. If America bears the cost, America should control the terms. That idea alone disrupts decades of financial assumptions. So when markets hedge, when currencies adjust, when volatility rises, it's not a rejection of America. It's an acknowledgement that America is no longer predictable in the way it once was. Unpredictability favors the negotiator, and Trump is a negotiator. I've seen this dynamic before. Whenever a leader is willing to walk away from bad deals, markets initially recoil. They don't like losing optionality. They don't like boundaries. They don't like red lines. But once outcomes begin to crystallize, those same markets stabilize, often stronger than before. The discomfort comes first. The clarity comes later. What matters is that the underlying structure is sound. And right now, it is. American institutions continue to function. Capital markets remain deep. Liquidity remains available. There is no systemic stress signal flashing beneath the surface. What you're seeing is a political stress signal, not a financial one. That distinction is critical. Political stress comes from decision-making moments. Financial stress comes from failure. We are not in failure. We are in decision. That's why the reactions look the way they do. Let's talk directly to the idea of fear, because fear is being sold aggressively right now. Fear keeps people passive. Fear keeps people compliant. Fear keeps old systems intact. But fear doesn't describe what's happening. Preparation does. Investors are preparing for outcomes they can't fully model yet. Governments are preparing for negotiations that may not go their way. Institutions are preparing for a world where American leverage is no longer theoretical. And preparation always looks like caution before it looks like confidence. This is the moment where weak leadership would reassure markets by promising continuity. Trump does the opposite. He reassures America by forcing change. That's uncomfortable for markets in the short term, but often beneficial in the long term. Now, I want to speak directly to the audience that supports Donald Trump, because this part matters. If you believe America should negotiate from strengths, if you believe American workers should not be sacrificed for abstract global stability, if you believe trade should be fair, not just free, then what you're seeing right now aligns with those beliefs. This is what asserting national interest looks like in real time. It doesn't look smooth. It doesn't look polite. It doesn't look calm. It looks like markets recalculating. It looks like institutions adjusting. It looks like uncertainty for those who benefited from the old order, and clarity for those who understand leverage. There's a reason panic narratives focus on gold prices and currency charts without context, because context reveals intent. And intent right now is not retreat, it's pressure. Pressure to renegotiate, pressure to rebalance, pressure to enforce. Markets are responding to that pressure, not fleeing from it. That's why you still see capital flowing through American systems. That's why you don't see mass withdrawal. That's why confidence hasn't vanished. Because despite all the noise, the United States remains the central pillar of the global financial system. What has changed is how that pillar is used. Trump is willing to lean on it, and leaning on it shifts weight elsewhere. That creates friction. Friction creates heat, and heat creates headlines. But heat also reshapes structures. This is not about 1 week of trading or one set of charts. This is about a broader transition, a transition from passive leadership to assertive leadership, from assumption-based diplomacy to leverage-based negotiation, from quiet decline management to open contest. Markets always struggle during those transitions. They prefer environments where outcomes are pre-agreed and power is disguised. Trump removed the disguise, and now everything is being repriced. That doesn't mean the repricing is permanent. It means it's honest. I've watched this enough times to know how this usually resolves. Once negotiations move from signaling to structure, once funding debates move from headlines to resolutions, once trade frameworks move from threats to terms, the hedges unwind. Gold cools, currencies stabilize, volatility fades, but the leverage remains. And that's the part that matters, because when leverage shifts, outcomes change. This is not the end of a cycle, it's the midpoint. And midpoints always feel uncertain because direction hasn't fully revealed itself yet. But direction is forming, and it's forming around a very old idea that nations should act in their own interest, that power should be acknowledged, not hidden, that strength should be used responsibly, but unapologetically. Markets will adjust to that. They always do. The question is not whether America is strong enough to handle this moment. It's whether the world is ready to deal with an America that remembers it is. I've seen what weak leadership looks like. I've seen what strong leadership looks like. And I know the difference. Strong leadership unsettles markets first and stabilizes them later. That's where we are. Not at the edge of collapse, but at the center of recalibration. And history tells us that recalibration, when guided by resolve, favors those who act, not those who wait.